Hello, do you know which type of the mortgage is available for home buyers in Canada? In this video, I'm going to talk about the several and also most important type of the mortgage available for home buyer. Number one is conventional mortgage. In this type of mortgage, the borrower has to pay at least 20% as a down payment of the purchase price. So if you have a 20% down or more, you are qualified to get this kind of mortgage. In this type of mortgage, you may not require to get the mortgage insurance as well. Number two is a high ratio mortgage. This type of mortgage is named as a high ratio because the borrower or the home buyer, they are paying less than 20% down payment. For example, some of them, they are a first-time buyer and they don't have enough down payment. They pay 5%, 10%, or even 15%. In any of this case, they have to, and they more generally, they have to get the insurance through the Canadian Mortgage and Housing Corporation. It's named CMHC. So who is getting the high ratio mortgage? That's just only the first time home buyer, they can get this kind of mortgage. This is kind of advantage for the first time home buyer because they don't have enough down payment, so they can get this kind of the mortgage. But obviously, when they are getting the lower, with the lower down payment, you need to pay more financing cost and your monthly payment will increase, and also you need to pay the insurance. Number three is fixed rate mortgage. May you hear the fixed rate. In the fixed rate mortgage, the interest rate remain the same in the period of agreement you have with the bank or lender. For example, if the Bank of Canada increase the rate, still your rate is stay the same. I think this kind of mortgage, you can say this term or this condition of the mortgage maybe is good for the people they have a fixed income. So number four is a variable rate. Variable rate actually is tied to the benchmark rate, such as the Canadian Bank of Canada rate. For example, if the Bank of Canada increase the rate, your rate and your monthly payment also will increase. If the Bank of Canada decrease the rate, your rate also is linked that and is going to be decreased and your monthly payment will be decreased. This type of the mortgage, I think it is better for people they are willing to take more risk, or maybe they have a variable income, not the fixed income or maybe salary. So they are willing to take a risk if rate go high or rate go down. And in terms of the payment or the repayment before the maturity date, if somebody want to pay it, so they will pay a lower penalty. In most cases, it is a 3-month interest in variable rate. However, in the fixed rate, may you face the higher penalty. So if you are considering to buying a property and as a first residential home and live there, maybe fixed rate is better for you. But however, if you using as an investment property, or you want to maybe income property, or you intend to sell the property in near soon, maybe as a variable rate is better for you. It is depend on situation of each home buyer. Number five, you may hear the open mortgage or maybe closed mortgage. I'm talking about the number 5 and 6. In open mortgage case, you are allowed to pay repayment the mortgage full payment without the penalty. However, in the closed mortgage, there is a restriction on payment before the maturity date or before your term being end. For example, if you borrowing the money for $100,000 and you have an interest rate for, you can say the amount of interest rate is 20,000 in 5 years. So in 5 years you have to pay 120,000 back. If it is the open mortgage, you have an option. If you get the money, whatever reason, for example, in next year or the coming years, you pay full amount of mortgage or the part of the mortgage, then you avoid the paying the more interest. However, if closed mortgage, in that situation, you have a restriction to payment. You have to stay with this amount until end of the term and continue to pay the interest rate based on your agreement. In Canadian real estate market, they have a kind of mix of the fixed and open in mortgage as well. You may have an option to pay maybe every year by 10% of your balancing your mortgage balance, not more than that. If, for example, if you have a 500,000 mortgage, you can pay 50,000 a year, not, for example, 200,000 a year. This I want to know the difference of the closed mortgage and the open mortgage. Another one is the second mortgage. Second mortgage, its meaning, as you see, the name is the second. There is a first mortgage and the second mortgage. When you buying the property as a borrower, you getting the first mortgage from the bank or maybe lender, whatever sources. When the time is going up, you may decide to renovate the property, or you may decide to buy another property, whatever reason, or maybe pay some of the debt. Whatever reason, you can apply for second mortgage. As long as your property has a value and you have enough equity on the property, then you can get the second mortgage as an option for doing whatever you want. I think this is a good opportunity, good option for the investor. Maybe take out some money and put the down payment for another property. Home equity line of credit or HELOC. This is another type of the mortgage in Canada. This type of mortgage is depend on your pre-approval limit and also equity on your property. If you have enough equity on your property, equity is meaning the money you can cash out the property after the mortgage. So that is the equity. Usually should be is over 20% done. You will have it there, 25%. And then after that, whatever amount is remain, then you can use as a line of credit, home equity line of credit. So it is depend on the value of property and your approval. Another terms you may hear, there is a bridge loan. Bridge loan kind of is a short-term loan, and you can say kind of short-term mortgage. In bridge loan, when you have a bridge loan, actually bridge loan is filling up the gap between two transactions. In real estate, if you buying a property, for example, closing date is in 3 months, but you sold your own property and closing date is 4 months later, you don't have money to close your purchase. In this case, you can ask your bank, give a bridge loan. Bridge loan is the short-term loan, obviously with the higher rate, but it's easy to solve the problem, and you can fill out the gap. Also, bridge loan they can use for business and also for the builder and developer. When they are building the property, they need to fund, a short-term fund, and until they will get permanent secured financing. So bridge loan is help for the builder, for the home buyer, and the business. This is another option on borrowing the money. Number 10 is the reverse mortgage. Reverse mortgage is the type of the mortgage actually applied for the homeowner with age of 55 or over. As long as they have enough equity on the property, they can get some part of the equity as a income free tax. Because in the many cases the homeowner need the money, but they don't want to sell the property. In this case, they can get the reverse mortgage. Consider they have equity for 200,000 and they can get maybe 100,000, 50,000, whatever they need. And the payment is whenever the property will sell in the future. For all of these type of mortgage, all of the condition, including the rates, payment, and all the terms, it's appear on the mortgage commitment. It is the paper is coming from the lender. You need to check carefully before signing the mortgage commitment. So here was the most common type of mortgage in Canadian real estate market. If you find this video is helpful for you, please subscribe my channel and follow me on Instagram. See you in next video.